Guys, with the spectre of inflation looming so large over the markets, it seems the ghost of inflation past has returned to haunt our present. With both stock and bond markets pulling back, let's take a look at some key risks we're facing as the Fed finds itself boxed in, stuck in a conundrum of hotter inflation, despite expectations of the market for rate cuts in 2024 looking much less likely. Let's turn our attention to BlackRock's April 2024 Outlook report, aptly titled Student of the Market, that was just released this week. This report illuminates a disturbing trend in the market, highlighting the risks associated with the positive correlation between the stock and bond markets. Traditionally, we investors typically hedge stock downside with bonds, hoping that stock losses could be offset with modest bond appreciation. But currently, they are correlated at historic highs, meaning we could see a repeat of 2022 when both stocks and bonds declined in the face of rate hikes. What does this mean? Simply put, both stocks and bonds could tumble down together in 2024, posing a significant risk to investors. This report serves as a stern reminder of the complexities and potential pitfalls in today's market, emphasizing the need for astute market analysis and strategic diversification. With long-duration bonds tumbling even further of late due to massive government debt load, the Fed appears to be able to fiddle with rates merely at the front end of the curve. And with cash money markets and short treasuries of 1 to 2 years giving wealthy investors such a high yield with no risk, it's ironically stimulative and inflationary to high net worth individuals, and that means even stronger high-end consumer demand and inflation. So we're in an interesting period where the Fed may have actually reached a peak on rates, where higher rates are driving such huge levels of government interest payments that they themselves are in effect granting a stimulus. According to WisdomTree's recent market outlook, the revised forecast for stocks and bonds presents a complex picture. The outlook indicates a potential shift in market dynamics, with stocks facing increased volatility and bonds struggling with higher for longer rates and entrenched inflation, perhaps at a new normal 3% versus the Fed's staid 2% target. These revisions significantly impact the market, causing investors to rethink their strategies. The implications for investors are profound: a need for caution, diversification, and a keen eye on market trends. This revised outlook from WisdomTree provides a nuanced perspective on the current state of stocks and bonds, offering a glimpse into the intricate dance of inflation and market forces. Take a step back to a few days ago. Fed Chairman Jay Powell made headlines when he announced that progress on inflation was slower than anticipated. A rate cut, once seen as a likely move in June, is now suddenly off the table. This news has sent ripples through both stock and bond markets, leaving investors grappling with increased uncertainty and a premium of yield demanded for US Treasuries. Due to greater uncertainty, that means bond yields could broadly and unexpectedly launch higher and create a crisis in the bond market that ripples into stocks. Meanwhile, a curious dichotomy has emerged. While the high net worth consumer remains strong, the average person on Main Street seems at odds with this picture. This disparity has become increasingly pronounced, highlighting the complex and multifaceted nature of our current economic landscape. And as if this wasn't enough, the heat of election season has added fuel to the fire. With inflation looming as a top concern across markets, candidates and constituents alike are weighing in on this hot-button issue. So what does this mean for us? The answer is as complex as the problem itself. The path forward is uncertain, and the impact of inflation on our markets continues to be felt in ways both big and small. In conclusion, the current state of inflation paints a picture of a market in flux. With the Fed's stance on a rate cut shifting and the disparity between high net worth consumers and average people growing, the impact of inflation looms large. As we move into an election season where this issue is at the forefront, one thing is clear: the ghost of inflation past is very much a part of our present. Pay close attention now more than ever to yields on bonds and understand bonds as the key to whether this stock market can hold. Unfortunately, the key risk now is that just like in 2022, 2024 could give investors the unfortunate surprise of declining bond prices due to rising yields, and the spillover into the stock market, as stretched valuations won't like higher yields, zero Fed rate cuts, nor a contentious election season.